Well, medtech and health-related stocks have been an area of big bang for our investment bucket under the radar. I mean, we've had a track record of around 130% in terms of our average return per the 13 or 14 stocks that we cover. So the reason for that, I think, we've got a background in the sector over a number of years, but we're looking for companies with strong track record of product performance and strong R&D pipelines. And of course it comes back to management, when there is so much uncertainty surrounding the sector, and of course a strong balance sheet. But I guess what's interesting at the moment in the sector is the takeover activity. There's been huge takeover activity in health and biotech around the world, but especially in Australia, where something like $2.2 billion worth of takeover activity has already occurred in the first few months of 2018, including Certex, which has been taken over, and there's been some other takeovers. But I mean, one recently in a stock that I covered in the UK was Shire Pharmaceuticals. They've been made a takeover bid for $40 billion by a Japanese company, Takeda. So why are these companies interested in niche pharma and small biotechs? Because they've realised it's better value to buy in that kind of niche expertise rather than develop it themselves. Small caps are often bite-sized for big companies to purchase. So that's what we've been talking about with the MedTech report. But what they also are is companies that can develop explosive earnings, because it's simple arithmetic. Growing a company with an asset and capital base of $100 million is going to be a lot easier than growing a company with a $10 billion capital base. I mean, if you have a good return on equity, you get that compounding effect of the reinvestment of earnings, so you can get that supercharged growth. Of course, there is higher risk, and that's why we step in and do solvency analysis and the like to make sure that you're protected. Also, I guess with small caps, they're often not correlated to market returns. So if you're buying big caps, it's very rare for them to outperform the market simply because they are the market. So small caps, I guess, like with the biotech and medtech reports that we're doing, are companies that aren't necessarily correlated to the market and can really supercharge your returns. Lastly, these sort of companies aren't looked at by brokers because fund managers aren't investing in them, because they're simply too small to make a difference. So when their fundamentals do measure up, they start getting the interest of parties like fund managers, and then brokers follow suit, and then you get that virtuous circle. So you can really get that double whammy effect of upgraded earnings and upgraded multiples that investors are paying. All our team cares about is when to buy and when to sell. So sometimes we get it right, like we did recently with Afterpay. We got in there at $2.50. We saw that stock, climbing very quickly in a matter of months to over $7, and we thought there's too much priced in for the US business, which is in a very nascent sort of stage, and also there's regulatory risk. So there we got it right, but I mean, we would say that we often tell subscribers to take profits and sell half your investment and let the rest of the profits run. So that does capitalize your, your gains, and that's important. But also, I think with the timing on the buy side, it's important. Sometimes there is value, like with these momentum type stocks, like Afterpay was. When they crash, they really crash, and we've looked at GetSwift, and we've seen that it's trading at a discount to its cash asset backing. Now, we've done some research which you can read on the blog. But what that points out to is sometimes, when there is seemingly good value, it's not always worth jumping in. And I think in this particular market where, the average stocks are at pretty expensive levels, it pays to do your research, which is what we spend all our time doing. Well, we've got the biotech medtech report, so we've got a lot of stocks that we cover in this sector because it's an area of focus. But also we're looking at themes like the ageing population. We've been successful over a number of years with Ingenia, which focuses on providing accommodation in retirement communities and manufactured housing. There are other stocks in that sector that we're looking at, and we'll be covering that. And that sector really is benefiting from a combination of new technology and growing demand for their product. So it's always worth looking at where there's big demand. We've got a pretty broad subscriber base of lots of different risk profiles within people. We've talked in the past, and we talk about what constitutes a speculative investment versus one that's a buy and hold type investment. So we've talked about that in the past. We take subscriber questions in all forms, but we also produce, interviews with professional investors or fund managers, and these guys really do spend all their time like we do investing, so they come up with some good wins, but also their mistakes and how they've recovered from their mistakes. So we think it's important to learn from both success and failure, and that's what investing's all about.